I hear you, Dan.
Awesome. I saw your cursor moving around. Sometimes I get a virus and my cursor moves around like that by itself.
That's interesting.
I did. I had to call Dell to have them remove it because my three softwares couldn't do it. So anyway, folks, yeah, just a quick update here looking at the intraday indices, that low that Greg called earlier today. Good call. I chickened out on selling the daily puts. I forget if they were, I think they were 40 cents at the time we were looking at it, and now they're like a dime. So that would have been a nice $300 profit. Even with a stop under the low, because of time decay, it's there's only an hour and a half left of the trading day. So that's why we love selling short-term premium. That it's the hourglass, tick tock, tick tock. As long as it goes, well, it could take out the low, but since that 264 was so far away, even if you got stopped out under today's low, it would still be at a profit. So, just slopping around here, nothing to do, but the breakout right before 2 p.m. Eastern, failed. And, now we're right back down to the support zone. And I hope it's not a boring afternoon. And it could be setting up that way, which is still fine for Monday, provided we don't get a gap down disaster. They're talking about Syria war, this and that, but who knows? I'm watching this volatility trade. We had an awesome initial entry, and then we had an awesome ad. And because of the contango on this thing, and again, that's just the headwinds caused by rolling futures. Oh, Greg, actually, I was thinking of doing that today. Here, let me pull it up. Hey, Greg, do me a favor. Pull up VIX, or I'll do it. Never mind.
I'm showing the screen, Dan. What do you want to see? You'd have to take my screen down.
No. I want a website, VIX.com. I'm sorry, VIXcentral.com. But I can do it.
Okay.
Remember, it's a two-step process, not one step. All right, folks, I'm going to just give you another way to explain contango. VIXcentral.com shows you the contango over time. So let me just try to simplify this for you. The April volatility, and this is the VIX, is well, stupid things getting in my way. 17.95. Okay, so put yourself in the position of the fund manager for VXX and UVXY and all the others. The only instrument that you can trade on volatility is based off of VIX futures. It's not based off the SIBO Volatility Index, VIX. That's a monstrous misnomer. So put on your hat for the hedge for the ETF manager. So this is April right now, and the VXX is trying to mimic the 30-day out implied volatilities of the VIX. So he, the manager, or she, the manager, every time 30 days, well, actually, they do it almost daily, believe it or not, because their fund prospectus says, hey, the average is the 30-day implied volatility of the S&P 500. I wish this thing wouldn't keep popping up on me. So what I'm showing you in this graph is the further out in time you go, volatility typically is higher in a succeeding month than it is the current month, prior month. So look at April, May, June, July. Every month is higher than the prior. Now, for some reason, August, maybe it's just a slow time of year. For some reason, well, it's only 5 cents difference. So let's just call that flat. And then October, November. But so this is not what's called complete contango, where every single successive month is greater than the prior month. But this shows you, pretend the manager has to roll the April futures to May. He is selling futures, however many thousands of contracts he has in the fund, for $18 a share. He simultaneously has to buy May futures at a higher price. So immediately, the value of the fund went down. And that's why I gave you the analogy yesterday, or that he's constantly, and I said 5 quarters for $1. Maybe it's more accurate to say he's exchanging 11 dimes for $1. Or, 21 nickels for $1, whatever the case. But this is what contango is. So when volatility falls, well, let me back up. Volatility is high right now. Let me now go back to this. So here's the VXX. If you would, well, let's start with the weekly chart. Look at the folks. This is Exhibit A of contango. This was 120,000 in 2009. Sure, it has blips, and that's where you have to get out of the way of a freight train, slamming on your head when the market sells off. And we do that. That's why we use charts. But this is contango. This just has massive, massive, massive headwinds. Now let's go back to the daily chart here on the bottom left. So this was the February sell-off. This gap down right here, we were selling the heck out of bear call spreads and volatility in our 2 advisory letters, and simultaneously selling put spreads on the spiders because they were opposite and they were climactic, with using Greg's new defined term, which I like, was cranked. This cranked volatility gives us high premiums on selling puts on the spiders and pretty much anything, but we just focus on the spiders because, why go to 10 individual things when we have a perfect instrument right here? And when volatility gets cranked like this, we get like a double whammy in selling out of the money call spreads on this. Volatility of volatility is cranked. So we sell these out of the money calls for crazy high prices. I mean, I could go back into my Thinkorswim platform and actually tell you what it was here. Maybe I'll do that once Greg starts talking, just to continue this lesson. I'll do it on the other laptop. But I'm just giving a guess right now that on this close, on this day, on February 8th, let's just eyeball this and say it was at 55, 56, whatever. I will bet you that we could have gone out a month. So that was February. We sell the March, let's say. I'll bet I could have sold the March $90 calls. 90, that far away, $45 away, or 35 rather. And I'll bet we could have got close to $1. So That's volatility of volatility. So here, you know the bottoming pattern in the spiders that we've been focused on for weeks now. So because of the bullishness of the spiders and this overbought high level of volatility at resistance, this was, so our initial entry was, I forget if we did it on this green bar or this day. I forget, because I've had multiple orders. But this is my basement floor, so to speak, when I was telling you. I'm shorting volatility when the spiders are holding. And because of contango, even if the spiders don't fall, they could go sideways. This volatility should contract because two reasons: contango, which we just reviewed on VIX Central, and number two, volatility is high because people are scared about something, an unknown event, this and that. So once, using Greg's term again from the other day about, clarity and the uncertainty of the decision being resolved one way or the other, once we start getting more clarity that the world is not going to blow up, this is going to contract. It's a mathematical certainty. And so, futures are nervous right here. And I don't think I want to add over the weekend, but any bounce here or continuation on Monday, because we're shorting out of the money calls, the 55s. Let me look at a number right now. Well, here, let me look at I added a 10 lot yesterday. I did the May 60, 21 days out, so that's 3 weeks. I sold the 60 calls, which is $5 over this. And then I bought the $75 calls, just a 10 lot, and I'm up $262 on a 10 lot already. Let me see what it would cost, or just what the current price is. All right, to buy it back right now is 33 cents. We did it, I think at 50, or no, it's 60, and that's why I have 270 open gain. That makes sense. 60 minus 33 is 270. So we sold this at 60. So in one day, I'm almost at 50% of max profit in one day. And that's why, when volatility contracts, it does it fairly rapidly. And I don't want to put on more right here at 33 cents. I prefer a sell-off to get a bounce, sell-off in the market, that is, to get a bounce in this. But I am thinking, and this is 3 weeks out. So because of volatility, I can go out to May, which is 35 days. Here, let me show this. Here, I'm going to show you a different screen. Hold on. I got my Thinkorswim on 2 platforms. All right, well, that's my spiders trade. I had a bunch of those on. Wow, my delta is low now. Okay, VXX. So I have a little 2 spread on for 1 week out, but this 10 days is what I added before yesterday when I gave it to the advisory letter. But let's just jump out to May, because remember, volatility of volatility is going to contract. So I'm okay with going out further in this, because so this is Vega, is volatility of the underlying. So look at these numbers. So we can go out to the 60s again, but that's for May. And let's say I did a 60. a 60-75 bear call spread. Wow, volatility is already contracted. It's only 59 cents right now, whereas these are the identical strikes that we sold yesterday with 21 days to expiration, and this is 35, and it's the same amount. So I would have to go out an additional 2 weeks to get the same premium right now. And that it's just, you know, volatility is a vicious instrument to buy. And that's why when we do buy it, you have to be totally right on direction. So here, let me show you that, and then I'll turn it over to Greg. Let me go back to my screen. So here's, I'm back to the daily chart of the VXX. So look at this. Back in August, resistance, downtrend. This day, and I have it on YouTube, so, you know, it's proof that I'm not lying to you. This day, January 29, this green day, we had a breakout from, you know, bottoming pattern here, you know, the 20 curled up. We said it's okay to buy volatility because the market was extended, and, you know, I think we had a breakout failure on the spiders. And so you buy volatility, and then when it gets extended, we're shorting it. So if this were anything, Microsoft, let's say, would you be concerned right now if you were long Microsoft on this pattern? It rallied from, you know, 27 bucks to 55. Now it's wide and whippy and breaking down from this. Of course you would, but we also have, you know, contango on our side. So that's why I just love shorting volatility on these spikes. And my two tools are the chart of VIX and the chart of spiders. And that's how we timed it. And you all saw it live the last 2 or 3 days. All right, that's enough on volatility for now. So Greg and others, feel free. Okay, wait, there is a question here. Yes, John, it has worse. John's asking, what about UVXY? Does it have the same headwinds? The answer is worse headwinds. And let me throw back the question to ask you why. Why? Why does the UVX have worse headwinds? Let me just show the chart of that again real quick. Here's a daily of UVXY. Tell me why the headwinds are worse. Easy. It's a levered instrument. It's 2x the VXX. It's levered. Any levered instrument, yes, any levered instrument is going to have that X, whether it's 2 or 3x of, you know, of the drag. And because of the way they rebalance daily, these levered instruments, being on the right side is going to help you. Being on the wrong side is going to hurt you. And those that have taken our volatility course, we explain that. But here, you know, the same breakout here, this was the day, February, you know, let's just call it here. So it was like 1050 and it rallied to over 30 bucks. So that's a 300. I'm not showing. Did I do it again? Jesus. I just need to learn to dance because I'm not good with that two-step. Okay, so sorry about that. So this same breakout in UVXY around 10 bucks. Look at this, rally to 30. So that's 300%. So yes, this thing has contango, but you have to manage these rallies. Look at this, you know, rally, 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 rally. Now it's breaking down. But let's look at a longer term chart. See, you aren't going to believe this. And that's when I told my friend from Canada about this mathematical certainty. He's like, Dan, there ain't no mathematical certainty in trading. I'm like, take my course. So look at this levered instrument. Well, it was, just call it 13,000. And now it's 17. That's because of it. Whenever it gets too low, what does it do? So I'm giving you a quick quiz. What happened? What is the fund? Well, the fund manager doesn't do it. The exchange does. But why was it that high and it's only 17 bucks now? And what happens when it gets too low? What does the exchange do? I'll give you a hint. 4 for 1. What does that refer to? Exactly. It's a reverse split. When it gets too low, they reverse split it and, you know, jack it back up there to whatever, you know, the split number was. It's typically 4 to 1 on these things. So they'll jack it back up to 50, whatever the case. Goes down, reverse again. Goes down, reverse again. And I've actually had a discussion with Greg before that, in my experience, because of this drag, and I told Greg, I said, we need to find a hedge fund that specializes in this and then just gives us a mark. Once we explain it to them, gives us a marching order that says, neither Greg or Dan shall ever take a stop on my VXX short calls, you know, whether it's the VXX or call spreads like we like to do. Because say you could short the VXX and the UVXY and it will fall with contango, but we love shorting the calls because we're getting a double whammy. We're getting the time decay of shorting a call on the underlying that has these headwinds. So I want to find a manager, and if you all know any, give them our email address, that says, look, I'm giving you guys, you know, 10 million bucks. Thou shall not ever take a stop. I hear what you guys are doing. I see it. You've proven it. Just short every bounce.
Dan, are you meaning to show a screen now? Because there's nothing there.
No, I'm not. I turned it off. No, I'm just concluding. So all I'm saying is, if you could sit through the drawdowns, which could be vicious depending on the sell-off in the market, just keep adding on bounces. And that's why I don't want to sell naked, because then somebody might get a margin call. So even me, I showed you my own account. I sold the 60s, but I still just bought the 75s because I know my maximum loss, and I'll just keep rolling it. So I don't want VIX to go to 90 like it did in the 08 crisis, and then, you know, you blow up your account and then you're mad at me. So anyway, that's enough comments for now. Market's starting to weaken here a little bit, so that was a good time for that discussion. And so I'm not going to be adding a VXX over the weekend, but I have no problem holding my position here, and I'll be looking to add next week. All right, Greg, have you looked at anything over the doldrums by chance?
Yeah, but everything is just grinding here. I mean, going into the weekend,
All right. Yeah, I think it's going to be a boring afternoon, and that's just my prediction, with slight possibility of another sell-off into the close. You know, I can't rule that out myself.
Yeah, so it's just going sideways up here on the hourly, and wasn't able to recover when it tried. You can see right here on the 5-minute when it popped up there, it just could not get it going back to the upside. And it's, I had said that before lunch, that most of the time these type of situations don't get back up above the opening price at this time in the day. So
why weren't we shorting a out of the money call spread that expires today? Thanks a lot.
Well, that didn't mean it wasn't going to go up somewhat, but if it was out of the money above today's high.
Absolutely.
Well, when I said it, that should have been your cue to look and see what premiums there were.
Yeah, I must have missed that. But you're absolutely right. And let's just spitballing it. It was let's just call it 266. We probably, and I'm just guesstimating, we probably for $1.50 out of the money. My guess is we could have got anywhere between 30 and 35 cents. But again, on a 10 lot, that's a nice dinner.
I'm bigger than you, Dan, so I don't know how much.
Yeah, and your wife likes expensive champagne. That's part of the problem.
Yeah. Netflix giving it up, but how's the gap up today? I'm just looking for what might be worthwhile as an intraday short here.
Amazon breaking down.
Yeah.
Well, now Amazon's a little bit of a bear flag on the daily. And a nice topping tail on the hourly. Let's see if we can get paid for a 90, well, now a 1 hour trade. Let's see what no, only a dime for the 1450s. Yeah, we aren't going to get any more juice today. And a dime on a stock that's $1,435 is less than a penny. So you always got to keep that in mind too, how, the price of the stock. McCabe IG report released. I wonder if that's causing any of this weakness.
I don't even know what that is.
I don't either, actually. I just saw it on the headline. But yeah, I have. I'm still holding some spider puts that expired today. I got some of the 261s and the 262s, and they'll just go out worthless. But subject to the next hour. In my inbox, and I use inbox synonymous with inventory. Our Apple and XLE are still holding up well. Google is still green. Yeah, the oils are all green. Micron down a little bit, but we're short the 48.5 and 49 puts, so those will go out worthless. So, Greg, just curious, what's your game plan going to be for Monday, based on your, if you were looking at the market right now as over the weekend?
You'll have to read it in the letter.
Nice. I was trying to get a freebie there. At least you give me a discount. That's nice.
Well, you know what I do, Dan. I'm going to go through these broader markets and look at the weekly and the daily and the hourly trends and put together what's going on there overall. And, so, I mean, just, I threw the weekly chart of the spiders up here and, and what is your conclusion? Basically the week was another yawn. So you see the lower right, the lower part there. I mean, you got 3 weeks just going sideways, and so far it's above its opening price on the week. So, and it's up on the week. So we could conclude that the week was a positive. And here's the 5-day. You can see on the minder here, the 5-day chart. Spiders at this point is up almost 3% on the week. So you focus on what's going on right now and say, oh, the market's falling apart, blah, blah, blah. And you push up into higher time frames and puts it in perspective that it was actually a positive week, but it's just continued choppy, grindy kind of stuff. I mean, it started down, so.
Right. Yeah. I no, but you're, of course, just in terms of looking for new positions, I'm totally sidelined because I don't like the gap and crap engulfing on the daily. I need more data. So.
Sure. But, going in, that's kind of been the MO. But if you were, wanted to put on positions right now, we'd still be looking at put credit spreads because you've got all these bottoming patterns. And today is just a, correction day. And, within that bottoming pattern that's occurring.
Right. So I'm just saying out loud that I have no problem putting those in the letter because then we don't have the weekend gap risk. I'm just saying I see nothing to do right now myself into the close, and that's why I'm just prepping them that I may not be giving them any ideas.
Yeah. Hill Philly Girl's asking me about the room and a little confused about that. So she's asking, she doesn't understand the membership. You get the green room for $47 if you buy 2 other things for $97. Is that correct? No, that is not correct. What that is saying for the $47 membership is those that have purchased the Master Trader Technical Strategies course and the options course can get the room for only $47. Whereas someone that just says, hey, you know what? I don't want to buy any of your letters, your seminars or whatever, but I think you're doing a good job in the room with trades and education. That's $147. But anyone that would buy a course or a letter, and such that is, become a member of Master Trader, then the room would only be $97. So it's kind of like, depending on how much you have, participated in what we offer, the price goes down. And then, of course, as a yearly subscriber, it goes down another 33%.
Yeah, and another way of looking, I like looking at it is, yeah, the higher price is the rate, but we're just giving our loyal subscribers a nice discount.
It's true.
Wow, nice wide range bars here.
Oh, just based on this negative day, I'm going to look through stocks that are trending down. So Philly Girl saying, what is the least I must buy to get the $47? Is that a monthly cost or once and done? To get the $47, you would have to buy the maximum. Well, you wouldn't have to buy it. You would get some services for the month. But if you were to purchase the options course and the Master Trader Technical Strategies course, then it would be $47. to get to buy nothing. And the monthly course, you know, if you paid for the yearly, it says it right on the site. I think it's $98. Which we can take a look.
Wow, Greg, that Dropbox that we looked at yesterday. Holy cow, that's a bearish island reversal today.
Yeah, they were talking about it on CNBC, or somebody downgraded and said that it wasn't worth, you know, whatever it was trading at. You know, that other services were less. And
I love island reversal patterns, particularly when they're extended in that same direction. And yeah, this would have been a good call spread, out of the money bear call spread on the gap down and bounce. Because it's new, you know, volatility's high, so we would have gotten juice.
Mm-hmm. So, you know, all of you that have ever heard me speak in a webinar know that I am vehemently against putting an indicator on a chart other than a moving average. However, you see what I have in this scan here, in this red scan, and stochastic. Why would I want a stochastic on there? Because indicators are a good tool for scanning, because they allow you to do some type of measurement as to is it overbought or oversold in some aspect. So a stochastic can be at a higher level and it could go sideways. And that's one of the reasons that makes it a subjective tool. However, it's one way of putting it as part of a scan. So if I sort this by downtrends with higher stochastics, I can then possibly find stocks that have moved up. And of course, not necessarily so, because the, you know, in theory, that is supposed to be what's happened when a stochastic moves up, but it doesn't always. So, yeah, I've got a stock that is bouncing up and could probably be worthwhile putting on a list for next week to see if it rolls back over. But these are not the best setups for shorts, because this was climactic to the downside. And a lot of times they don't go down, you know, in the same way as they did. Now, this one is interesting to me. Well, not really. I was hoping, because the daily is starting to roll over like that, the 5 minute wouldn't be extended, and it had a drop and down near support. So no go. I should have scanned some of these earlier. I just came to was doing other stuff, but this is what I'm doing. So now bounce up, reversal. Now I want to get these kind, and this is a thinly traded stock. And I can see that by these dashes here and these dots. So it's not that liquid, but this is the picture of what I want to short on a 5 minute chart, pretty much exactly, for intraday setups. That arrangement of price to moving averages are so this looks like a good short right here. I mean, it's a slower mover. I'm just pointing out examples here, but the intraday doesn't match it. So I can't do anything. I'm going to give you a fess up here to a reaction to this jittery market. But I did it. Now I'm looking at it and going, damn, I was short Twitter at lunchtime. And, you know, the market just being as jittery as it is, you know, and it started to pop back up again. And then I covered it for a gain. Wasn't that much, but, you Now it just tanked here as the market got worse. It happens. And it's in the downtrending list here. This should be up here. This is, Dan, something for a call credit spread. I mean, it's down quite a bit, but it's retesting here on the daily and a reversal at the 20. Biogen, I know we hate biotechs. This one, it's a big one, not likely to get
and the
blindsided by big news.
The breakdown failure on the daily doesn't concern you, and the monthly bottoming too?
No, because again, I'm preaching to the choir with you, but I mean, it's all about days to expiration. Well, this is a nasty downtrend, and it's retesting the high. Just because it had a breakdown failure and whatever the monthly looks like, it certainly doesn't mean that it's going to go up.
Yeah, no, it's very juicy. Did you check earnings?
Right here. Well, there you go, 424.
See, you're always trying to suck me into trades.
Well, I just point out the charts. Your job to figure the option things out.
Because we could have done the 275s or $1.50. That's very juicy.
Into some low volume stuff here that's in the scan.
I have a snap on my high volatility Thinkorswim scan.
Yeah. That got beat down today, and it was popping up at lunchtime.
Yeah, nice round trip on the weekly also.
Yeah.
Yeah, it looks like the news is, blabbing about Syria and Russia, getting people scared.
Mm-hmm.
President George W. Bush back in the day took a shot at raising tariffs on Chinese steel, and millions of American jobs evaporated afterward. The Trump administration says its steel tariffs will be and are different. Up next, a longtime owner of a metal fabrication company squarely in Trump country says we're repeating history already. And Facebook is right. Frustrations over Facebook data flood starting to subside and will not impact the company's stock.
U.S. Steel is oversold on support, but it sure can't get out of its way.
Yeah, I was looking at that before. I was looking for possible shorts, but it didn't pass the intraday test.
Right. Wow, this Boeing was a big disappointment. Look at that.
Yeah, well, it gave it up with the market.
But you said there was some negative news, and it still gapped up. I thought that was the positive. I love stocks that outperform the good or bad news, because that means that the market was overpricing in that greed or fear.
I didn't read the article. I just saw, a headline, something about, I was on what had something to do with Russia. So who knows?
Well, and also Boeing's in the category of, the trade wars. It's going to get smacked because of, obviously their big ticket purchase items, and if there's going to be tariffs on them, that's going to hurt them pretty good. Oh, Greg, you're talking about contrarians. Here's the front page of the business section of the Wall Street Journal. Big article. Tell me what you think without even looking at it. Well, you know, but I'm kind of baiting you anyway. When you hear the following headline, "The thrill is gone as the frenzy over Bitcoin fizzles." Are you just on that headline alone? If you were in a, stock trading Jeopardy game, so to speak, are you a buyer or seller?
A buyer.
Absolutely. Me too. Like, who wrote this article?
I can't bring the futures chart up on this platform, but
do GBTC.
But the futures were testing a bottoming tail from a couple of months ago.
No, right. So my question to these clowns, it went from 20,000 to 7,000. Why are you calling this the frenzy over Bitcoin fizzles now? I'm looking at a lower high double top. It's at 17,000. Why didn't you write the article then?
Well, because there was a lot of fizzle. Right? I mean, it's obvious now. Why do people short after things are going down 14 red bars?
Yeah. Wow, selling picking up here.
But one other thing you'll notice is that I wasn't looking at it right now, but not long ago, CNBC had the quote of Bitcoin, what level it was at, and how much it was up or down on the day, and then as it got lower, they just removed it from their lower left screen there.
Right.
Your VXX is popped up to the high of the day, Dan.
Yep, I'm watching. Right. So that's another good question. Could I have covered mine and then just, re-entered it on Monday? Of course I could have. But that's what I did on the spiders. I was pretty heavy coming into today, and I've taken profits on a lot of it. So I'm holding some for next Friday as well on the spider puts.
The tick just hit minus 1,000 after this decline, so it might be over short term. Actually went down to almost minus 1,200 or 1,250. And that's, those of you that are trading intraday or short, you're short, being aware by just setting an alert on that NYSE tick, you don't have to watch it. But if things are weak, you're short, and that alarm goes off at minus 1,000, you start trailing even a 1 minute bar. It's late in the day, but look at this chart. Something should jump out at you immediately looking at these two charts, especially the bottom one, knowing what's happened right now over the last couple hours and how we're in the market. It's totally oblivious to the market going down. Now, it's up too many days in a row on the daily to consider as a late day breakout play and the market's negative, but this thing just sideways. Buyers keep stepping up. They don't care. It's finally starting to pull back, Dan.
Which one are you looking at? Pull back? Oh yeah, I just 2 minutes ago looked at that and guessed GES.
I had this on the list for a pullback at the beginning of the week, and it never pulled back.
No, right. So the point I was going to make is if you own the stock, here's where you sell covered calls on them.
Yeah.
Exactly.
All right. Things probably chop around for a half hour here, but we will see.
Yeah, Greg, remember you told me a week or so ago, you said watch ExxonMobil, XOM. You said you thought it was bottoming.
Mm-hmm.
And the dead low bottoming tail. Look at that. That was the day.
Oh, but you told me there's no premium.
Correct. Right. So I said it had to be directional, but no, I was just pulled. I'm looking at some Dow stocks and CVX, XOM are green. Wow, even Walmart turned green. So I'm glad we held off there. Procter and Gamble and Coke are green also.
Mm-hmm.
Well, both of them. Procter and Gamble and Coke are.
Maybe I can head off a little bit of updating and looking at what's going on here. Actually, I think I have a different page just with. No.
GLD, that would be a good put selling candidate, but its volatility is too low.
If I had a page with just the ones that I track for the letter, the trends. I got too much stuff going on even that I know which page had what on it. But I mean, this is a great help, this platform. I don't know what I would do without it, just to be able to get through, all of this information in a relatively short period of time. And this is a great exercise, not only, and definitely for myself, but, for those reading the letter, even to do this yourself, going across the broader markets and sectors and looking at the trends in multiple time frames, it really forces you to stay in tune with what really is versus maybe getting caught up in what you think, so, gold has done nothing for the longest time. And, looking at the weekly chart, it's pretty much still doing nothing, but it's at the bottom of the trading range. So, if there was premium there, like you said, Dan, these would be good for that. So, I going over to this minder here of the stocks that are in that ETF, I can then even sort it by what was doing best on the week. I think this is just another gold ETF there, but maybe we can find something that makes sense. So maybe GDX doesn't have premium in it, but maybe something else within the sector does.
Definitely. Yeah. ETFs typically are going to have lower premium than the sum of the parts for that reason, because they have to arb and there's less gap risk, and they know that.
Mm-hmm. So this one's up a few days, lower price, probably nothing there, I would assume.
Well, and the obvious next question is, how far are you willing to go out?
You know me.
Right. So you're going to get nothing for a week. It's zero. The 5 put is 0 by 5. Even going out to May is only a nickel. So that's a big veto.
So here's something on the weekly chart that I like.
Yeah, me too.
Even as maybe just to buy it, if gold and silver are turning here. Now, I don't want to do it right now because it's up 3 days and up at the top of the range on the daily time frame. But this bottoming pattern on the weekly and nice week, I'm definitely putting it on the list for next week. And I'm just going to check the flag, which now puts it in my minder of stocks I want to look at considering long. There's a low price one. So not everything in the sector is going to look like what the bias would be. And here was the NEM from the other day, continued to move up. But nice weekly chart. So this one, say, because these are at the top of the range and they start coming in next week, you probably get better prices for selling those put spreads, Dan.
Absolutely. But with a nice weekly like that, I have no problem going to May. Do you?
No.
And now the final question. Go ahead.
Yeah. Hill Philly girl said she's been watching Triple M. Could you sell next week 212.50 put for $1.59 and buy the 210 for $1.07, considering that Triple M has been in a channel? Tell me why this would be a horrible trade, Dan.
Well, easy. I mean, the market's coming in. It's a bearish engulfing bar on the daily. It's a bottoming pattern. There's no bullish impetus for me to want to sell a bull put credit spread on this. I mean, we can find a whole lot better ones. So no, I would not do that. Hill, do you like, we need a nickname for her. Do you like Hill or Philly better?
Philly, of course.
Well, I knew it wasn't girl one, but maybe it is. Yeah, that's just, I have no interest in just the pattern. And as you know, that's our very first focus. No pattern, no trade. Just move on.
But I mentioned this morning, and, that this is, while a channel, it's going sideways in a downtrend, and the market did grind higher, right? The S&Ps were up about 3% on the week. Qs are up 4% on the week, and Triple M on the week is actually down almost 1%, right? 1.8 points. So if we, start leaning toward the bearish side a bit more because of the market, and I'm not suggesting that, but because today was an ugly day, which, Mr. Schizophrenic could gap over the high of this bar tomorrow, and we could see a measured move higher. That could definitely be in the cards with this market. But if this was to follow through to the downside and you sell that bull put credit spread, you're going to be in some pain next week. So we always try to put multiple pieces of our analysis together. So when we look for bull put credit spreads, we might look for a pattern like this, but after it just starts coming out of the top of the channel. And we have had our share of even those that have bitten us, right, Dan? Where they are certainly bottoming out and look like they're going to go, and they don't. So, but this one has shown relative weakness. Is this a Dow stock? I think so. Yes. Your favorite stock, Dan?
Yeah, GE.
Up on the day, 2.43%. Almost 3.5% on the week.
I mean, I wish there was more premium to it, and I have no problem selling puts on it. but I don't know why there's no juice on it. Unless you wanted to hold over earnings, but next week, well, the 13 or well, the 13 for next week's 22 cents. When's earnings?
Next Friday.
Oh, then that's not worth it. So if you went out to May, the 12s are 17 cents. That would give you a cost basis of $11.83. But let me check the volatility. Wow, the implied volatility rank is 96, which is high. But
So how do you explain no premium and the volatility rank is that high?
Well, maybe it's because it's a low price stock, because it still does meet my 1% rule. So, so let's go 2 weeks out. The $13 put is 27 cents. So that's, or 28 cents. That's 2% for 2 weeks. So I guess I'm just in my head wanting a bigger number to entice me to do it. I guess that's all. But it is 2% for 2 weeks. And also, when you look at implied volatility rank, it's relative. Implied volatility on a stock is relative to itself. So a 97% ranking is just saying that you look at the current volatility of GE, and then you just compare it to the prior year. And they're saying it's the upper 97 percentile of the prior year.
Right.
But volatility of Tesla and Google and Amazon are greater than the volatility of GE. But then you have to look at where the rank is on those individual animals one by one. Like I'll tell you right now. Let's go through it. So Tesla, for example, implied volatility rank is 95. So it's in the top part of its range. Amazon, 94. Google, 93. Apple, 89. So that's because of the spiders are, the market's still nervous. The implied, the IV rank of the spiders are 86. But just the other day, they were 95 when we started selling puts on them. So you can see that the volatility of the spiders has come down, at least from the implied volatility percentile, has come down 9-10% already in just a couple days.
These stocks that I highlighted in the minder, those are the ones in the Dow that are reporting earnings next week.
Okay. And just point of observation, your 1200 negative tick reading set the low of this last fall.
Right. And that's why I preach to use it, just even to set an alert. No one really has to look at it moment to moment, but
now there's buying. Look, the tick is at 900 now.
Yeah, it's whatever. A little buying or short covering, but
right.
IBM and Goldman Sachs next week. So maybe Goldman will save the financials with some incredible earnings report.
The way they got whacked today, I think that would be a challenge myself.
That's why it's a shock pattern.
Right, but I'm saying it would be a shock to Goldman Sachs. My point is, I'm not sure if it could drag the whole sector up.
Well, I don't think it'd be a shock to Goldman Sachs. They probably, if they know what their earnings are going to be, they're probably sitting on the bid all day.
Wouldn't that be unethical?
Don't tell anybody. Oh, we got like we got American Express coming out, and there, right? And Philly Girl said, call her Pat. There is a channel that we want to see which way this is going to go next week, because this is going to report on the 18th. Ready to lift the G and Procter and Gamble. A lot of these are just sideways junk.
So let me just, I got to go leave in a second for a meeting downtown, but let me just say something to Tim here and the others. And it's kind of a comment about greed and legging into covered calls. So we're long QEP, and Tim's asking me, hey, what, you can read it. What call do you recommend? And so I pulled it up. There's not weeklies, unfortunately. So you got to go out to May. And the $12 puts for May, 5 weeks out, you can just hit the bid for 40 cents because they're 40 by 45. And if you take, here, I'll do the math for you here. So 40, I guess, 0.4 divided by 11.26 is 3.5%. 3.55. So say my 3.5 that I just guesstimated was dead on target. So you're making 3.5% cushion to lower your cost basis, and it's 75 cents away. So even if the stock continued to rally to 12 bucks, this 3.5% is gravy. And then you make, here, let me do the math on that. 75 cents divided by 11.25. It can rally an additional 6.67% plus your 3.5. So if you add those two together, that's 11%. And so any, student or novice trader or whatever the case that says, oh, Dan, I would never do that because then I'm capping my gains. I'm like, dude, you don't get it. So this analysis is if the stock continues to rally and it goes over 12 by May expiration, you've just locked in 11% additional return in 5 weeks. And here, let me do the math on that, and then I got to go. So how you annualize that is as follows. So it's 0.11, and I can't do times 12 because it's 5 weeks. So what I do is I multiply it times 52 and divide by 5. And that is 114% return by this analysis, by you selling the call right now. So when somebody tells me, oh, Dan, I don't want to cap my gains, I'm like, you're in the wrong business. You don't get it. So yes, I think that's a great trade there, Tim. And then if for some reason it consolidates and gains its strength back, whatever the case, you can always buy the call back. And you have, even if you might hypothetically lose a nickel or a dime or whatever the case on the short call, net, because your underlying went up, you're still profitable. It is impossible to lose money selling calls on positions you have. It's impossible. You've only possibly capped your gain. But if you're talking about capping gains, making 11% in 5 weeks, then I got no problem with that. All right, perfect, Tim. Good job. All right, I got to head out to a meeting. Everybody have a fantastic weekend and look forward to more good trading next week.
Talk over the weekend, Dan.
All right, see you, Greg.
Okay. Well, there isn't much expectation for much more to happen here. But, I'll just flip through these sectors. So XLE did not pull back at all. It continues to show that strength, and this weekly had a very nice reversal. Hold on a second, guys. Okay. And same thing with gas. Consumer staples did absolutely nothing. And this sector just continues to be weak. And from a bearish point of view, then go and look at, well, not always what has been the weakest might be the best. It might actually be, some might be good for what was actually up for a reversal, but I'm looking for things that look like they will continue to go down. This sector just cannot get any legs whatsoever. No, Tony, it's going to be open. The room will be open next week as well, for another week. And then after that, if you want to subscribe, you've had a couple of weeks. And I don't know, if you were in here all week from when we started, but after next week, you can decide if it's something that you'd want to do. Yes. So next week, I've already got those set up. So you will get an email over the weekend with the link to access the room all of next week. And those of you that are on YouTube, YouTube works this is working flawlessly with this chat software connecting, but not that it's a big deal, but it is delayed. So if we were to, speak about a recommendation, most of what we do is not, well, I haven't really gotten into too much of the day trades yet, but really not at all. But with those, the timeliness of it could be a little bit of a disadvantage being on YouTube versus being in the room. But if you get on our email list, which I'll be sending an email out to the whole list with the link, you can access the room and be in it, because on the YouTube, I don't know exactly how much of a delay it is. Let me just change this chart. I can just look at it myself and see. It's about 10 to 12 second delay after I change something as to when it updates on YouTube. And that is the, I guess, how YouTube saves some bandwidth. So next week is going to be, it could be another difficult week in that you've got these weekly reversals, but dailies that have inched up into resistance areas within a downtrend. And what typically happens, well, a number of things, of course, could happen, but looking at it from the point of view of if the weekly chart can begin to follow through, and I'm just talking historically how these patterns typically shape up, is what happens. Let's get a little drawing tool here. Where is it? Ah, there it is. What typically happens is you got let's just use XME here as a potential sell setup. Now you got this weekly green bar retesting that low, and there's a lot of stuff that looks like this. This will start on its way down most of the time, and maybe it has to come to here before it finds its legs where buyers, based on the higher time frame, want to step up, and that's where we start to get some type of reversal. And as we always do, what we just kind of eyeballing any wide range bar like this big green bar is the correction we want to see stay in the upper half, and that would be right around here. If it came down, so you could just apply this to anything you're looking at, any of the sectors or any of the, the broader markets that might look like this. And it's just as a starting point for what's happening. So if this pulls back, we'd want buyers to show up in this area, and it could go sideways, of course, but, just moving right up from here, with all this junk up above isn't really the ideal scenario. Transport's backed off from that prior high in the 50, but still green on the week. Right, that construction index. And this is the problem with bottoming patterns. They're bottoming, So wide range bars like this clearly tell us that big money is stepping up. That's what creates them. And you look for the volume confirmation, and that's there. However, it's not unusual with a bottoming pattern for prices to retrace deeply into the strength of that move. Of course, they have to hold down here and then start again. But this is, what bottoming patterns do. They show strength, and because they've been weak, they come back in again, and then the whole process starts again where, those that have been buying down here look to add to positions. This is some relatively new ETF, and I did look at what stocks are in it, but it's not active yet. Global X Robotics and Artificial Intelligence. As new ones come out, I throw them in a list to track them. What is the normal green room schedule, Tony? We actually email that out. So the normal schedule is, we start at 9 o'clock. Usually I open it up before that so you can log in, of course. And the schedule is, at 9 or just a little after, Dan will come on and update or open positions if they need to be to speak about that. And then at around 9:15, I will come on and review the overnight session, maybe different sectors that are moving, stocks that are moving, what might be gapping. And then, as the market opens until, usually around 11, usually 11:30, we are on the mic and looking at things and placing trades until 11:30. And then the schedule is, as long as things aren't really active, is to take off between 11:30 and 2:30. If things start to move and I'm here or Dan's here, we'll come on, of course, but, we catch up on different things. Dan goes to the gym. I try to get to the gym early before I start. I'm more of a morning person, to go there early. And then we come back on at 2:30 and see what we can find for the afternoon, until 4. And then depending on what we find, of course, then, we send out the letter to subscribers and do some videos if it's warranted. This is I'm looking at this hourly chart here, and I have these moving averages on here. They usually for my daily, but anyway, just to kind of put in perspective shorter time frames, whereas you're looking at a 5-minute and even a 2-minute, and it's like, oh my God, it's the end of the world, and kind of the way it's just fallen off a cliff. And the hourly chart was just what's turning out to be. The market's going to close in a couple of minutes, but what would turn out to be, if it could come back up, as a shakeout. We shall see on Monday if we get some follow through here. I would like to see, well, it could gap up, when I said, a gap up like that would open up the door to a move up, but a sideways move here, going sideways and then a move up, it provides a much easier way to participate versus, the gap where things could move really, really fast. As you can see, a lot of green bars on the weekly. Let's see what was the best performer on the week. Oil, of course. All right. Biotech, which was a bit of a surprise. Look at the weekly chart here. To just gap up and run like that. XOP is oil. XLE is oil. UGA, I think, is natural gas or gasoline. Metals, gold and silver popped up. And then there's the biotech. So, all right, everybody, I hope you enjoyed the time in the room. This was our first week opening up the room. But this is what we'll go through it every day, looking for opportunities, managing open positions, and educating. So we will continue next week. I will send out a link to get registered for the room, and we will talk then. So everybody have a great weekend. And hey, Joe, I know that name. Joe, in on YouTube here. How you been, Joe? Awesome. All right, Joe, if you're not on, and anybody on the YouTube there, if you're not on the list, I know. If you're not on our mailing list, go to the website, Master Trader, and at least sign up for the chart of the week so you will get the link if you want to come into the room next week. But we'll be on YouTube again. Yeah. That's how I remember your name, because I remember it from way back. All right. We will talk next week. Have a great weekend, and talk then. Bye-bye.